On March 10, 2023, Silicon Valley Bank, one of the well-known lenders in the startup ecosystem, collapsed. Established in 1983, SVB was the 16th largest bank in the United States and became the biggest US bank to fail since the 2008 financial meltdown. The downfall of this banking giant has created a ripple effect across the global financial system. The crash initiated a cascade of events causing other banks to collapse. Signature Bank in New York, another entity closed by regulators after its customers began withdrawing cash. The banking sector across the world reported steep losses. Swiss banking giant Credit Suisse faced brutal turmoil followed by these catastrophes. The concern over here is this another 2008 depression-like situation? Hello and welcome. You're watching The Delight of Wisdom with me, Bhavya Neeraj. In today's episode, let's try to figure out what exactly happened to SVB. Why did the Silicon Valley Bank collapse? How this mayhem impacts the stock markets? And more importantly, as investors, what lessons you and I can learn from this loop? A profound understanding of these economic events will help you to master the market. So let's delve deep. This is the second largest bank failure in the history of the United States. Headquartered in California, the Silicon Valley Bank catered to the financial needs of tech companies around the world before a series of ill-fated investment decisions led to its collapse. The question is, what are those decisions? To comprehend this crazy story better, let me take you to the pandemic days. The initial market shock of the pandemic in early 2020 provided a golden period for startups and tech companies as consumers spent immensely on gadgets and digital services. As the best bank for the tech sector, SVB services were in hot demand throughout the pandemic years. Then why it collapsed? Friends, to revive the economy from the pandemic tsunami, central banks across the world were circulating excess money in the form of cheap loans. So the economy was flooded with free money. Startups were able to raise funds easily due to inexpensive credit during that period. And friends, you know what? Many tech companies used SVB to hold the cash they used for business expenses, leading to an influx of deposits. SVB wanted to make a huge profit from all of this cash. So they invested their funds in long-term government bonds when rates were near zero, including those backed by mortgages. What's interesting here is these were for all intents and purposes safer than equities and provide a steady return. Then what went wrong? Let's try to figure out it. You see, bonds have an inverse relationship with interest rates. When rates rise, bond prices fall. Wondering how? Don't worry, I will explain. But before that, I have already done a video on inflation, interest rates and their impacts on financial markets. In case you want to get a clear idea regarding that, I am providing the link in the I button. Please watch it. So, when the Fed, which is the Central Bank of America, started to hike interest rates rapidly to combat inflation, SVB's bond portfolio started to lose significant value. When interest rates are low, newly issued bonds pay lower returns, making existing long-term bonds that pay higher returns more enticing. This leads to an increase in demand for these bonds and an increase in their price, rewarding its holders with profitable returns. SVB used this opportunity. They invested $80 billion of their tech company deposits in long-term bonds and other securities, and they pay their depositors a lower rate. The difference between the higher rate long-term bonds and the cost of paying low rates for the deposits would be their profit. If depositors want their money back, the bank sells bonds to repay. As economic conditions worsen over the last year, with tech companies particularly affected, many of the bank's customers started drawing on their deposits. Everyone wants to withdraw money at the same time. By the end of 2022, there were $15 billion in unrealized losses from the drop in long-term bond prices. Normally, this is not an issue as the losses are unrealized, that is, they exist only on paper. If SVB were able to hold those bonds for several years until they mature, then it would receive the capital back. But this was not a normal time. In a high interest rate environment, tech startups were struggling to get financing. They needed cash to fund their operations. Startups being the main client for SVB, deposits declined. SVB didn't have enough cash on hand, so they started selling some of their bonds at steep losses, spooking investors and customers. On March 8, 2023, SVB announced its decision to sell off its entire bond portfolio. This caused fear among investors and customers, and as a result, it collapsed and was seized by regulators. Guys, you know what? It took just 48 hours between the time it disclosed that it had sold the assets and its collapse. I hope you got a clear idea of what happened to SVB. Alright, now let's have a quick look at the crucial causes of this tragedy. A post-crisis market is not appropriate for a high interest rate environment because it develops dangers in weak areas of the economic system. The risk management team of the SVB failed to foresee this. When inflation began to rise in the United States in late 2021, the Fed, instead of raising the interest rate for taming inflation, did nothing for a while. They said it's transitory, and this turned out to be completely incorrect. When the Fed learned their mistake later, they had to increase the interest rates very fast to make up for the lost time. This whiplash in increased interest rates didn't let time for the market to adapt. Meanwhile, at SVB, their investing environment began to reverse. As the interest rates increased, the newly allocated bonds started to pay higher returns, and this made the older long-term bonds unappealing to investors. As a result, there is a decline in demand causing their prices to fall. And when SVB sold their entire liquid bond portfolio, they took a $1.8 billion loss. So to cut a long story short, this collapse was a shocking negligence on the part of the management. And of course, the Fed did get it incorrect when they said that inflation was only transitory. But the management could have avoided this disaster. Wondering how? You see, when the interest rates started to escalate, rather than waiting and selling old bonds at huge losses, they could have begun to offload their long-term treasuries and exchange them for bonds delivering higher interest so that they were able to control the losses. What's your thought regarding this? I would love to hear that in the comment section. Let's now dig deep into another significant concern. Is this the start of some big financial crisis like the 2008 depression? Well, for the regional banks, yes, this is a Lehman moment. Why? Because like SVB, their clients are businesses. They have limited diversification, that is, their field of operation is confined. Moreover, they all have some exposure to unrealized losses in this high interest rate environment. The stock prices of most of these banks have all seen brutal plunges. The decline in stock prices was so drastic that trading was temporarily halted in most of these banks. But what about global banks? According to financial experts, as global banks have more diverse funding sources, they are less vulnerable to this risk. Many are worried that this is another 2008 Great Recession-like situation. But this is quite different, and you know why? Because during that time, some of the biggest banks in the United States failed simultaneously, and they had much bigger problems to deal with. These banks had fairly large investments and assets that overnight became worthless. Unlike that, the assets that are responsible for the SVB collapse are not worthless. They are backed by the US government, and if held to maturity, they are not going to lose any value. But the problem for SVB is that they sold all of these bonds early and realized losses, tried to raise funds to cover those losses, and that triggered a panic. Another reason that this is different from the 2008 crisis is that the banks in the 2008 financial mess had humongous leverage issues. For instance, in the case of the Lehman Brothers, the leverage exceeded 30 times the underlying assets, or in simple words, absolute bankruptcy. And lastly, the big banks have a far greater degree of diversification than regional banks, making them more immune to liquidity shocks, as generally not every single sector gets impacted at the same time. Does this mean that there is no risk of a financial crisis? The answer is no. We can't ignore the risk of a crisis. There is always a risk of a financial crisis even in the best of times. The financial system is complex and interconnected, and any major disruption can have far-reaching consequences. If panic spreads excessively, it will create a cascading effect that would cause the rest of the economy to shake. The authorities are already aware of this. The federal regulators stepped in to ease anxieties and limit risk in the broader financial system.
Every American should feel confident that their deposits will be there if and when they need them.
Still, there might be some short-term ramifications, particularly in the banking and tech sector. But always remember, the financial system is constantly evolving and new opportunities as well as risks are always emerging. And finally, as investors, let's explore the lessons that we can learn from this collapse. Here I'm not delving into the management fraudster in SVB's case, though SVB Financial Group and 2 top executives were sued by shareholders. I will try to explain a general perspective here. As investors, we have to stay sensible irrespective of the environment. Always observe the management of a business skeptically. Don't ask the barber whether you need a haircut. Incentives automatically influence the way people act based on how they are rewarded. This is an important concept in behavioral economics called incentive cost bias. It explains people with a vested interest in something will tend to guide you in the direction of their interest. For example, if you are working with a real estate agent for buying a property, he is primarily interested in convincing you to buy the property, even if it doesn't make any financial sense to you, because incentives influence the way people act. Similarly, the management of a business based on the rewards they get will tend to guide you in the direction of their interest. Don't trust forecasts or projections, particularly from someone who has a financial interest in making those projections. Obtaining information or trusting analysis from someone who has an interest in a particular deal is detrimental due to innate bias. Whether you are buying a stock or a house or a business, do your own research. Don't trust the experts. Review annual reports and other filings to draw your own conclusions, and always stick with businesses that you can evaluate yourself. Or in simple words, buy businesses that you understand. Hope you enjoyed this video. Subscribe to this channel for more videos like this. Also, if you find this informative, do press the like button and share it with your friends. Let's learn and grow together.